So clearly markets have been in flux. We saw some pretty dramatic sell-offs in the stock market at the end of 2018.
This Christmas Eve, the stock market delivering investors a lump of coal.
Credit spreads widened out, the yield curve was flattening, the 10-year yield in particular coming down. All of those things were signals of concern about the health of the economy and where we are in the business cycle. That said, the actual economic data have held in pretty well. We had a spectacular jobs report for the month of December. 312,000 jobs created with people coming back into the labor force. We've seen consumer spending hold in pretty well with a robust holiday shopping season. So to us, what's happening, what the markets are telling are that the risks are greater. The downside risks are clearly larger right now. And a lot of those risks are stemming from abroad rather than something that's happening in the domestic economy. So in particular, growth abroad has slowed. We're seeing a significantly weaker backdrop in China. So I think there is a lot of concern about the health of the economy in China. Part of that is because growth naturally has been slowing for the past few years. But now on top of that, we are seeing this trade war build between the US and China, and those increase in tariffs reportedly have started to play a role in Chinese economic performance. So part of the reason that US equities performed poorly at the end of 2018 was because of concern from what they were seeing in China. The Chinese equity market had a very difficult year in 2018. So that all bleeds into the broader state of the financial market. The challenge with identifying risk is that it's very hard to know in real time which factor is going to end up being what shocks the economy. So we could attempt to look at the potential areas of concern, and China would be certainly one of them. And it's not just China, it's how that spills over to Europe. The data in Europe has weakened, so there's lots of connection there as well. So you can certainly make the case that there's a lot of areas where things look a bit unsettled. And then even here in the US, there's concern over policy paralysis, or even worse, gridlock that leads to a negative confidence shock in the economy. And we're potentially starting to see some of that play out in confidence measures. Our baseline forecast for growth in 2019 is a moderation from 2018. So 2018, we had nearly 3% growth. A normal pace of growth for this business cycle is a low 2% handle, and that's what we think we're going to see this year. But a growth moderation does not necessarily equal a growth contraction or a recession. The risks are higher, certainly than they were this time last year, but we're not seeing the typical signs that we would see in early stages of recession. So if the economy was truly entering a recession, we'd be seeing signs of initial jobless claims picking up, for example. So evidence that firing was actually starting to edge up, that companies were looking to shrink their labor force. That's not at all clear in the data. If you think about how a business cycle normally turns, there's an imbalance. There's overcapacity. We don't have that in this environment. There are certain areas where maybe there's slight excesses, but not to the point where we should see a real turn that would impair overall economic growth. So uncertainty is high. There's reasons for concern, particularly stemming from the global economy. But if you look at the core of the US economy, things are still looking quite okay. So if you dissect the labor force numbers, in particular the labor force participation rate, what you'll see is that the prime working age cohort, those that are aged between 25 and 54, have been increasing their participation for the past several years. The challenge is that the demographic forces on balance have been providing an offset, which means we have an aging population, so on aggregate our participation rate is going to suffer in that environment. One way to separate is to look at the men versus the women amongst the prime working age population. And what's fascinating is that women have returned back to pre-crisis levels. In fact, their participation rate is above where we were during the last recovery. But prime working age men haven't yet fully come back. And it's not obvious why. It could be a matter of time. It could be that jobs need to be made available in certain sectors that will help entice men of that age group to come back in. An important factor, I think, in terms of potentially helping to drive labor supply higher in the coming year is if wages can continue to rise. We are now seeing the majority of the major sectors in the economy see wage growth in excess of 3%. So the highest earners, the wages that are increasing the most, are in the sector called information, which is tech. That's going to be a highly skilled part of the economy. Wage growth is increasing very rapidly there. But you're seeing it now also in construction, you're seeing in leisure and hospitality, retail trade, utilities, and those are categories that are going to be impacted more from that global economy. So the fact that you still have more subdued wage growth abroad that feeds back into the goods-oriented part of our economy. So over the past several years, we've seen a widening of income and wealth inequality. It's not just in the US, it's a global phenomenon. I think part of that probably was a function of central bank policy. So with central bankers engaging in monetary accommodation, which means bringing interest rates down, inflating asset prices, that helped to create a divide on the wealth side because a large share of financial wealth is concentrated in that top tier of the income population. So part of that probably is a consequence of the extraordinary action, but it's an unintended consequence, clearly. But when you think about what income inequality or wealth inequality means for the broader economy, it does suggest a softer trajectory for consumer spending on balance, because the propensity to spend out of income, the lower income group, tends to be a lot higher than that amongst the upper income group. So the more that income is concentrated in the very top tier of the population, the lower the trend will be for overall consumer spending. I think the increase in wages is to be expected given that the unemployment rate is at such low levels. So the labor market is tight. And when you have a tight labor market and you have labor shortages, you tend to see wages increase. And you could make the case that some of the gains might be from minimum wage increases, particularly in the leisure and hospitality sector or the retail sector, where you have a greater proportion of that population on minimum wage. And certainly the tax cuts that we had seen in 2018 helped to spur economic growth that increased the demand for labor. So in theory, that could be contributing as well. But really, I think it's just a function of this business cycle. We have a low unemployment rate, we have tightness in the labor market, and in turn, wages are picking up.